Hello and welcome to this Friday's morning market briefing. We've got lots to talk about, but firstly, Eurozone inflation slows to 2.8% in January, as well as that, bank losses revive fears over US commercial property market. We've got lots to talk about in the charts, also with lots happening on the economic calendar, but we'll come to that near the end, so make sure you stay around so you see that. Before we get straight into it, make sure to subscribe. The first article to talk about, of course, is in relation to Eurozone inflation. Now, to begin with, inflation in the Eurozone fell to 2.8% in January, according to data released yesterday. This presents a murky picture for economists who expected the inflation figure to be lower. Now, of course, we've had a lot of important and influential economic data which has come out this week thus far, and all of that has definitely massively moved the kind of monetary policy expectations. As if we think back to it, going into the new year, we were kind of looking at interest rates even being cut, especially within the Eurozone, beginning March maybe. And that was the case for the Fed and the ECB. But as we spoke about in yesterday's briefing and the day before, that's kind of that perception in relation to the Fed's monetary policy has now also changed into one which is slightly more hawkish, where we aren't expecting those kind of interest rate cuts so early. And I think this kind of inflation figure that we got yesterday, from the Eurozone, also kind of reflects the same sort of thing, where although we're seeing a fall in inflation over time, we're still not quite seeing that significant amount that we would need to be able to say, we can start cutting rates in March. And as we've repeatedly heard from key policymakers within these key Western central banks, ultimately they want more data before they can make decisions on such important metrics such as inflation, and then decide and then make such key decisions in relation to interest rates. And that's why we've largely just seen kind of the progress in relation to interest rate cuts and the talks around it kind of slow, and we've continued to just kind of hear the rhetoric from both the Fed and the ECB that they're waiting for more data to come out. Now, this 2.8% figure is very significant indeed, because last month we actually did see an increase in the level of inflation within the Eurozone, which was a massive surprise, whilst we were expecting some gain in inflation kind of year on year. Ultimately, we were not expecting it that much, and this was largely because the month before we'd seen the greatest kind of drop in inflation annually for a very long time, with inflation now being in the 2% territories and the low 2% territories. But ultimately, this figure once again represents that there is still somewhat of persistent inflation pressures within the Eurozone economy. Now, obviously, within the Eurozone economy itself, there's nations within that, and those nations have differing levels of inflation. But ultimately, on the average and the cumulative figure for inflation, it does look like we are looking at a 2.8% figure in January. And this is obviously very, very important always for when you're calculating those key monetary policy decisions and understanding what to do next. I think, though, if we do continue to see kind of a fall in inflation over time, and we continue to near that 2% figure, remember that's the key inflation target for these main central banks, this 2% inflation target. If we do see inflation finally come down to that level, we could then start talking about, interest rates being cut soon. But ultimately, by that point, it's all priced in, and therefore investors won't be making much money on any trades in relation to that, which is why we're seeing kind of investors start pricing in interest rate cuts so early on. I mean, we were talking about it in November, so it's quite early that we do see investors start to predict when these inflation rates will reach the target levels or near the target levels enough for central banks to start cutting interest rates. So this is very, very important to, of course, understand and keep your eyes on. Now, going back to December, inflation rose by 2.9%, making the more recent figure a decline in inflation. Nonetheless, despite its possible insignificance. And this is largely because ultimately, we're saying, whilst we have kind of only dropped 0.1% in inflation. We are still in inflation on an annual chart. Ultimately, we are still looking at a decline in inflation. That shows progress, whether it be small or not so large. Ultimately, we are seeing progress, and that is very important for some institution like the ECB, which is trying to form this monetary policy kind of outlook, and it's looking at inflation data. And whilst it's seeing that we may have seen a jump in inflation on the last month, ultimately we are now seeing that continue gradual decline. But ultimately, whilst we are talking about just the headline inflation rate figure here, it is always that core inflation rate figure which is far more important, which of course excludes the volatile items such as food and energy. And as a result, that is really what these key central banks follow and look at and use to determine their monetary policy. So we will be coming to that figure in a second as well, with this possibly even aiding certain investors' perceptions that the ECB's rates will be cut soon. So seeing a decline in inflation on that year-on-year kind of level may lead some to kind of reinforce that position in relation to interest rates being cut very soon. That said, labor-intensive services prices have seen unchanged growth, which could lead certain ECB policymakers to be hesitant of rate cuts, since wage growth could worsen for inflation, with services prices rising at an annual rate of 4% for the third month in a row in January. Eurozone core inflation also remains slightly above expectations, dropping to 3.3%. Nonetheless, of course, that is still a drop, but it's the fact of whether these inflation figures are coming in above or below what economists are expecting, as this kind of matters when we're looking at short-term trades, because ultimately the markets price in whatever the economists are usually expecting. That's the general kind of pattern that we see. So ultimately, when we do see like a kind of discrepancy or like a difference between those two figures, the real figure and what economists predicted, we do see like gains and losses within the market. So that's why it's so important to kind of understand perceptions and that sort of thing. Following the data, investors priced in a reduction in the probability that rates would not be cut as soon as previously expected. So this does reinforce the idea that whilst with this data kind of representing still quite a bit of persistent inflationary pressures, this as a result has led to people starting to price in that it's less likely that we do see interest rate cuts in March. Now, as a result, yields on the 2-year German Bund was up 0.06%, with the 10-year rising 0.05%, with Western central banks in general now weighing up the risk of reducing rates too early and thus spurring on inflation, or not cutting rates early enough and therefore hurting growth, with ECB President Christine Lagarde, pardon me, I'm not with it today, saying it was premature to discuss rate cuts. This counters much of what investors are predicting, since the Eurozone economy stagnated much of last year, and thus led to many investors expecting rate cuts in order to mitigate the issues with waning growth. And that's largely what we've been talking about in regards to Eurozone growth and their economy, is the fact that we have seen kind of issues within the Eurozone economy, especially around growth, and that's kind of led to investors perceiving that the central bank of the Eurozone, the ECB, would cut interest rates earlier than previously expected. Moving on from that though, next to talk about is the US commercial property market. Now, banks in the US, Asia and Europe have been tanking losses recently, with this adding to worries over the weaknesses within the US commercial property market. Now, to be honest, we haven't really spoken much about the US commercial property market. However, we have spoken about recently the issues within banking in the US and West as a whole, with the US with the US banks, especially having issues around loans, which of course are now proving to be for position for those which took them out as, basically, you know, unpayable. I don't know whether that would be a good word or even a word that you could use, but basically, these kind of consumers, these other institutions, these other businesses aren't able to pay back these large loans, which of course they took out maybe in a different period of interest rates, and now we're seeing these kind of higher interest rates, and we're seeing more dire economic conditions for most businesses and consumers. We are, as a result, seeing a great deal of issues for such customers of these banks to then pay back those loans, and as a result they're not able to pay back those loans. The banks then take on that loss, and this is creating a large deal of losses for banks across different sectors, and as a result we have seen banks starting to lay off people as a result to try and cut costs in this kind of period, a weird period within time where we're not in the COVID lockdown stage. We're kind of emerging actually out of the high interest rate era, but ultimately the effects of both of those periods are still weighing on these banks and consumers, and as a result creating these deep issues within the US banking sector. Now, the US commercial property market has been under particular strain due to high interest rates, which has been leading to lower occupancy levels than usual, with US lender New York Community Bank Corp revealing large losses from commercial property, all the whilst other banks such as Azora or Deutsche warn of growing risks. Fewer individuals working in offices following COVID, as well as high interest rates, have driven a large fallout of many businesses from the US commercial property market, with the NYCB reporting $185 million in losses on just 2 property loans. This information has sent shockwaves through the markets, with the New York part of the new NYCB stock dropping by 40%. Worries over insolvency of regional banks has also triggered a rally in US bonds, with traders worrying over how issues with lending may affect the US's growth. So, important kind of notes to definitely understand in regards to US commercial property markets, as well as banks in the US as a whole. So definitely keep your eyes on the topics in relation to this. That's all to talk about on the articles, though. Moving on from that, we do have the charts, of course, where quite a bit is happening after some significant economic data did come out today. Obviously, we've just covered that data in regards to Eurozone inflation, but we also did see the Bank of England make its interest rate decision, which also moved the pound greatly as well, which we'll come to in just a second. But to begin with, of course, we are talking about US indices, more specifically, of course, the US 30. Now, the US 30 is in a very interesting position since it's been rallying for quite some time now. And this is largely as a result of the Fed changing its kind of monetary policy outlook to being one which is far more dovish in its rhetoric. And from that, we have seen the US 30 rally. However, as we did start off the year, of course, we did see kind of the US 30 stagnate just after making all-time highs. Now, since then, as a result of different economic data, as a result of different global news and different events, we have seen the US 30 now drive its way to the upside, breaking above those all-time highs and the top of that range that was formed during that period of consolidation and ranging, retested that area and moved greatly to the upside. Now, recently, though, just a few days ago, we did see a sell-off from those very recent highs. More specifically, on Wednesday, we did see a sell-off from those key highs. And in yesterday's market briefing, we were obviously talking about that sell-off. We were talking about that retracement, and we were talking about the key levels which price could reach as a result of that. And mainly, we were talking about the 3820 Fibonacci level and the 50%. That said, going, kind of exiting Thursday, we haven't really seen that materialize, and we've actually seen price retrace, yes, but not retrace to the levels that we were expecting, and instead price has not made it to that 3820 level and moved away instead far earlier than we previously expected. Now, that's not to say that it hasn't moved away from maybe some key liquidity zones, but still, it hasn't moved away from those key Fibonacci levels, but still, a very interesting position to note in regards to the US 30, and definitely we have some serious upside potential for the US 30 over the coming days. Whilst we are approaching the weekend, going into next week, it'll be interesting to see whether, if today we can now see the US 30 break above its all-time highs, whether we'll see that continue and materialize further into the next week. So keep your eyes on the US 30. It's a very, very interesting position to note. Next to talk about is the dollar, though, which is currently ranging as it's continuing this period of consolidation. This is kind of a surprise ultimately because we've had a great deal of economic data since the beginning of this kind of ranging period, but ultimately it does seem like all this kind of data, all this news in regards to global events is still not pushing the dollar one way or another, and in fact is just reinforcing the messages that the dollar, or at least investors in relation to the dollar, kind of were already expecting. And as a result of that, we're just seeing price not find much momentum one way or another. And this is obviously interesting to note, as of course we are receiving the US's NFP figure today, which obviously comes with the normal unemployment rate figure, and this largely shapes a large part of the US's monetary policy kind of outlook, and will definitely be playing into when the Fed does start to reduce interest rates. And I think that's what the market has been waiting for. Whilst we did have the Fed's interest rate decision, we did kind of talk about maybe the dollar is kind of waiting around to hear more about that, and then it can move to the upside or downside. Ultimately, the NFP figure is the key thing which will be changing the Fed's monetary policy outlook, and that's why it's so important to hear what's going on in regards to that. And that's why you should definitely keep your eyes on the news in regards to the US NFP figure, as that will be pushing the dollar one way or another. Keep your eyes on that. Next to talk about is Euro USD, which despite some interesting euro data yesterday in regards to inflation, it does seem like the figure wasn't important enough to push the euro overwhelmingly to the upside. That said, as a result of kind of hearing some more hawkish messages from that inflation rate figure, we did see euro USD push to the upside. Not too significant to note though, but definitely that NFP figure will be playing into the way Euro USD moves. Now, on the topic of pound yen, we did have the Bank of England's interest rate decision today, and there it was presented. More hawkish monetary policy outlook was presented by the Bank of England, and therefore we have seen kind of some buy-side volume kind of enter the pound, which obviously has stalled out at its all-time highs recently in this key liquidity zone. Price has now interacted with that lower level of liquidity along the 38.20 Fibonacci level, and obviously that, in addition to the fundamental news in relation to the Bank of England, has driven pound yen to the upside. So quite possibly, as we end off the week and going into next, we could see pound yen kind of make its way back up to those highs. So definitely keep your eyes on pound yen. Next to get through quickly is Bitcoin. Not too much to say on Bitcoin. Bitcoin has now just reacted to that key liquidity level though, so keep your eyes on Bitcoin. Next to talk about is gold. Despite so much important fundamental news recently, we haven't found a clear momentum one way or another on gold on the 4-hourly time frame. That said, a great deal of volatility entered the market yesterday as a result of lots of news in relation to fundamentals, as well as in key global news, of course, in regards to foreign policy and war and that kind of thing, which is obviously playing into world tensions, which pushes gold often to the upside. So keep your eyes on gold. And lastly to talk about, of course, on the charts is oil, which is in a very surprising position after selling off greatly after kind of pushing to previous highs most recently. So we've seen a great deal of volatility on oil, and this is in comparison to the great lack of volatility and momentum that we had seen since the start of January on oil till kind of the end of January. So a very interesting position for oil at the moment, as we've currently sold off and moved all the way down to this old liquidity zone, which prices previously interacted with and reacted to. So definitely keep your eyes on this zone as well. That's all to talk about on the chart. So lastly to talk about, of course, is the economic calendar, where we are getting quite a bit of data today, all of it quite significant as well. Now, firstly, We'll be getting French industrial production figures, as well as the Spanish unemployment rate figure. As well as that, we're getting the Swiss consumer confidence figure, and ultimately, and most importantly, we will be getting the US's NFP figure and unemployment rate figure. And that's the key important figure that we are getting today, so definitely listen out for that. We are forecasting 180,000 jobs added to payroll, so definitely listen out for that figure. And finally, we're getting the US's consumer sentiment figure as well. But that's all to talk about on the economic calendar. We've covered lots on the articles, lots on the charts, and lots on the economic calendar. Hope you have a great trading day this Friday and a great rest of your weekend as well. Enjoy it whilst you can, and obviously I'll be back with you next week. But that's all from us at Wildwood Capital. Have a great one. See you later. Bye.